everyone, and welcome back to Keys to Real Estate. I'm your host, Mary Schuster. Well, today's show opener is short and sweet since my guest really needs no introduction. Chuck Cain from F&F is here, and today we're talking through national issues in the realm of real estate and how they will impact work on the ground in your operation. So, no matter what question you're currently asking about the future of your business, and what's going on in Washington, D.C., and how it might all impact your daily work and outlook? Well, engaging with Chuck's vast experience and hearing his thoughtful assessments will be a benefit to you. So buckle up for a far-ranging conversation with a man I like to say knows more about more things than most people know about anything. Please enjoy my conversation with Chuck Cain. The presenting sponsor of the Keys to Real Estate podcast is RamQuest. RamQuest fosters a customer-first culture built around an unwavering commitment to provide solutions that don't just meet, but exceed expectations. RamQuest's newest title and settlement production solution, Horizon, delivers unparalleled efficiency, robust features, and scalability to ensure you have tools to boost productivity and elevate performance like never before. Horizon streamlines your operation with secure 24/7 access, automatic updates, and all the power that only the cloud can offer. Plus, Horizon offers a direct connection to the industry's most extensive network of service providers and partners. Experience Horizon for yourself when you visit ramquest.com. And now, please enjoy the show. Hi, Chuck. Thanks so much for being here today. We appreciate you joining in.
Thank you. Thanks for having me.
I have a ton of things I want to talk with you about. I'd like to start with some rank punditry if we can.
Okay.
I've been thinking about what two different futures might look like depending on how this November's presidential election comes out. So I'd love to ask you, what do you think are real possibilities?
Well, as the great scientist Niels Bohr said, predictions are always difficult, particularly if they involve the future. But I think that, if we have a continuation of the Biden administration, we're going to have more of the same. We're going to see, I think, a much tougher regulatory environment. We'll see the CFPB sort of unleashed, for lack of a better term, as they have been, certainly since the decision that verified that they are constitutionally funded. We have seen Director Chopra make comments immediately after that, okay, now here we go. And they certainly have been very active and across the board, not just in regard to title, obviously. So I think we'll see, more of that general push. We heard President Biden talk about housing in the State of the Union address. And for those of us in the title insurance industry, let's just say there are certain phrases that stood out to us in regard to housing. But the fact that he even mentioned housing, and I guess now it was about a year and a half ago, I had the opportunity to do a podcast with the late Dave Stevens, who was a great person in our industry because he understood both the private and public sector. And as Dave said at that point in time, and again, this is April before the State of the Union address, that the word housing had only been used once in a State of the Union address in this century. And that was in one of President Obama's State of the Union addresses. And it was there because Dave put it in. So it's never something that has come up. We have a housing crisis in the United States. We don't have enough units for the people who want to own houses. We, as a result, or part of the result of that, are the inflationary prices that we have seen over the last few years, because the demand has far outstripped the supply, and we have a shortage of rental units, which goes back to the comments, and say we're taping here in the middle of July, just yesterday, where President Biden was talking about a 5% cap on rent adjustments. So, we have a big problem in regard to housing. There does not seem to be, and Dave Stevens talked about this, he said there's no one in charge of housing. So, back in the 90s, HUD had authority over pretty much everything. The GSEs reported into HUD, HUD made all the rules, and HUD, of course, administered FHA. Well, today, HUD administers FHA, the FHFA administers the GSEs, and the CFPB makes the rules. So there is no sort of central point to resolve this issue in regard to housing. So on one hand, it was great to hear President Biden even discuss housing. Again, those of us in the title industry may not have been happy with some of the comments he made or some of the ideas about what might make housing more affordable for the typical American. But all that being said, I think we'll see more of the same. If we see a second Trump administration, I don't think the CFPB, it'll be interesting to see who it becomes the director, because we'll no doubt have a new director. Dare I say, I think many of us have heard that, Mark Calabria might be a possible person who obviously has the experience of running the FHFA and is very much tied to the Trump administration historically. Mark is a true libertarian. And so he has a very different view of things. So, we may see something more out of the Bureau like we did when Mick Mulvaney was there. More industry coordination. We'll see more in regard to, rollout of rules as versus the complaint about the Bureau virtually since its inception that it's rulemaking through enforcement. So, you don't know where the sidelines are until you're called out of bounds. I think that would be the difference, but I don't think the Bureau will be less active in pursuing what they view as being issues across the board in their jurisdiction, not just within the real estate industry. Payday lending, there's a whole variety of things that have been on their list, in part because I think the staffing there will remain very much the same. And again, they have broad enforcement powers. So I think we'll see a difference at the top of the Bureau. And as to how that may work. And again, it may certainly not be Mr. Calabria. It may be somebody else. But I think whoever it is, we'll probably see more in that direction as versus just coming down on people. The enforcement actions in the first Trump administration, I'll use that term. I have friends who would say, oh, please don't just refer to it as the Trump administration, not the first one. But certainly when President Trump was in, the Bureau was very active. The Townstone case was brought during the Trump administration.
That's right.
So I don't think we're going to see a significant layback in regard to that. We may see, again, in the Trump administration, we may see more judiciary appointments that may put more judges in that will be more, shall I say, private sector oriented towards things. The underlying problem is the housing crisis. And I'm not hearing either party really talking about what to do to solve that. The general mood in the Democratic Party is it could be solved through public sector. The general mood of the Republican Party is it's better left to private sector. But again, echoing our lost friend Dave Stevens, it must be public sector and private sector combined, or it's not going to work. So it'll be interesting to see. Right now, I don't know, as we sit here, it looks like the Republicans seem to be in the catbird seat moving forward here into the election. But it's 4 months off. And as you and I were discussing just prior to this, the last 3 weeks have changed everything. We could have another 3 weeks that could change everything again. Mm-hmm. So it remains to be seen. It certainly is, as the Chinese like to curse each other, interesting times.
It is the curse of living in interesting times. So let me follow up on a couple of those points, if I may. With respect to solutions being offered from the two viewpoints, I have heard at least the GOP ticket kind of talking about focusing on interest rates. And we know we've seen some proposals for perhaps a future president to be more involved in calibrating and deciding what the interest rate should be. So there is a little bit of discussion over there. What I found interesting from the current administration, going back to, especially but not exclusively, that State of the Union commentary we had, was the solutions they seem to be offering, at least right now, to me, have been demand-based, as in they would have the net effect of increasing demand. And we don't hear a lot about increasing supply. Have I missed that, or is that kind of missing from the dialogue everywhere?
No, I think you're exactly right. And I think if we had someone else on this podcast from the National Association of Home Builders, they would firmly agree. Interest rates, as I learned many years ago from a fellow named Larry Baer, who was an analyst in the real estate industry, interest rates don't determine if people are going to buy homes. Demand is what determines if people are going to buy homes. Interest rates determine how big a house you're going to buy. And so interest rates are helpful. But, interest rates right now hanging around the 7% number, as they seem to be up and down, give or take a quarter to an eighth of a point. First closing I did was a 16.5% VA loan, and the seller had to pay 4 points to get it. So people will buy houses.
Yeah.
And 7%, in the 45 years, shocked myself to say that I've been in the industry, we've seen rates all over everywhere. So interest rates are one component. I think that the financial markets, and from everything that I read from trade journals and Financial Times and groups like that, they are very concerned that if Donald Trump is reelected president, that he might interfere with the Federal Reserve as to how that works. I don't know that he would have that capability to do it. I don't know that he would do it. Sometimes, as we know, Donald Trump will say things because he wants to get a reaction. He wants to see what people say and perhaps influence people just by making his comments. There's a lot of concern about, would there be some intervention with the Fed? Would Chairman Powell be reappointed by President Trump? He sends mixed signals about that. So, I think that all remains to be seen. But you're right. As far as enough units and houses, we just don't have enough. And this has been a long-term problem that we've been building towards well before COVID, which for many people, it's like, gee, remember back what things were like before COVID? BC, as my wife likes to say. We were at a housing shortage then. And then the demand started to pick up. And we have more people in this country all the time. The demographic, we are right at the top of that pear-shaped curve in terms of number of people who are in first-time home buying age, especially. So, we'll see how this moves forward. And as people of my age, if they decide to sell and move into a condo as versus having a home, that may free up some inventory. But we'll see, because what the trends seem to be is that people are staying in their houses regardless of their age. And something that has been brought up by several analysts, right now we have really almost record low delinquency and default in regard to outstanding mortgages. And part of that, of course, forbearance came into effect during the COVID years. Well, forbearance locked up a lot of properties that prior to COVID would have gone through the default process. Unfortunately, people would have lost their homes. They would have been foreclosed on. And that would have freed up, tens of thousands, if not hundreds of thousands, of housing units. But right now, still, there aren't that many properties in forbearance, but we don't have that outturn of properties out of foreclosure either. When the market turns down, when the economy turns down, as we know it eventually will, and dare I say, regardless who the next president is, I feel sorry for them, because I think about 2 years out from now, things may be very rough, and there won't be a lot of easy answers. As far as, where we are in that freeing up of properties, that's another problem. Those are properties that have not been freed up. And of course, during COVID, because of the high demand, we had an awful lot of investors going in and buying properties for rental, particularly in those more affordable neighborhoods. All those things sort of combined to lock up a great number of houses, of existing homes. And again, the home builders bemoan the fact that on a regulatory basis, in so many places, it's so expensive to build a new house. And I was on a committee in the 1990s here in Cincinnati, put together by the mayor of Cincinnati, to try to increase home ownership percentiles in the city of Cincinnati, because at that time, we were still one of the top 25 metropolitan areas in the country, and our home ownership rate was the lowest. We were at 62% in the city. And here we are 30 years later, and after a lot of efforts, we've gotten that up to 63%.
You're kidding.
So success is just huge. It's a rental town. One of the big issues at that time, where the home builders said, well, this is all well and good, but you want us to build, at the time, houses for, let's say, $140,000, $150,000. affordable homes in lots in the city. That would be first-time home buyer, sort of, that FHA, VA marketplace that comes into to bear, and certainly is a pricing area for minority communities and underserved communities. But as one builder said, but I've got $35,000 in permits from the city. Other than the fact that altruistically, I'd like to do this, I can't make any money building these houses. In fact, I will lose money if that house sits for more than 90 days. I have to turn it almost immediately. And quite often those houses, because of the building costs, were smaller than the existing homes that were built in the earlier part of the 20th century. So all these things come into play. And I think it all echoes back to Dave's comment, there's nobody in charge of this. There's nobody to bring everybody together in the private and public sector to have meaningful conversations about how can we solve this problem, because it's been building for a long time and it is not quickly resolved.
Yeah, it's really good points. Well, and I wanted to ask you too about, so Chevron's been overturned.
Mm-hmm.
We have this next set of questions. They stand on their own, but they also kind of refer back to what do we think the Bureau will be doing in either administration. So we have Chevron overturned, which means that the agencies in general are going to have to probably play it a little closer in, a little tighter. I think that we're going to see a lot of challenges in courts too to things. This is more wild speculation. I'd like to hear your thoughts on just that and how it might affect things. And then if you're thinking about how the SEC case, the Jarsky case, plus the corner post case, plus the Loper Bright, the Chevron over, those to me kind of string together to create some interesting, there's that word again, interesting opportunities for the marketplace. So what do you think about those things?
Well, I think especially in regard to Chevron, or the Loper case and the overturning of the Chevron doctrine, it should be remembered that the Chevron case, when that case came together during the Reagan administration wrote an amicus brief in support of the Chevron doctrine. And it's been pointed out by a lot of legal analysts that during Donald Trump's administration, he used Chevron to eliminate rules that have been put into place. And that was the way the Reagan administration saw it too, that they didn't have to go through the Administrative Procedures Act to roll things back. They could simply tell the director, do it. And they didn't have to go through comment periods and so forth. It's, again, been pointed out by a lot of analysts that if Donald Trump is reelected, it's going to be tougher for a Trump administration to roll back rules that they may want to roll back, because they're going to have to go through APA requirements, which creates drag time, comment periods. And I think you're right. I think, the litigation, Dodd-Frank gives the CFPB some very explicit powers. And so that piece of legislation is very different from, say, the Clean Water Act or the Clean Air Act and the things that the EPA had to deal with. And a lot of that legislation that came out of the 1970s, 80s, and even 90s. So I think, the Bureau probably has a much stronger footing in regard to their rulemaking moving forward. While a lot of other agencies may struggle, but it cuts both ways. That, if you want to create rules or you want to eliminate rules, you're going to have to go through APA as versus just simply implementing the rule because, well, we think we should do this. We think this is part of our mantra here to be able to accomplish it. I think, too, that, Mary, you're and my brothers and sisters at the bar. I think it is in some ways a trial lawyer's dream, because we can see just litigation for years on a wide variety of topics, existing rules and rules that may be brought forward as to if an agency or bureau implements something without going through APA, saying that, oh, we have this authority to do it, that they'd be immediately challenged. So, and that'll come from both sides, from the right and the left, and I say both sides. I should say each side, and then perhaps both sides, where nobody's happy about how this moves forward. So it certainly pulls back the authority of the administrative agencies in the executive branch, but in some ways reduces the authority of the actual executive to accomplish a lot of things. Yeah. So we'll see, as this moves forward, though, and you and I have talked about it, Now, Chevron has been on the decline as far as a legal argument for 10 years. Fewer and fewer entities want to rely on it because the concern was, well, maybe it wasn't great law to start with. Maybe we don't want to rely on this argument because if it does move up to the Supreme Court, they're going to bounce us out. So it's sort of been in a recession in terms of utilizing the Chevron doctrine, but now it's effectively gone. And those agencies and bureaus that their enabling legislation gives them very explicit powers, and the Bureau has a lot of fairly explicit powers, they're going to roll right on, while those bureaus and agencies, their enabling legislation does not provide them with such explicit authority. They're going to be in court a lot.
Yep, I agree. And I'm so glad to hear you bring that up. I've been thinking similarly about how, because enabling legislation, the Dodd-Frank Act was constructed much more bulletproof. Not that there's any contract that's bulletproof or a piece of legislative text. If anybody out there knows Chris Dodd, love to have him on. Barney Frank, love to have him on. Would love to hear how they're thinking about this in a post-Chevron deference world. I agree with you. I think that the CFPB is set up a little bit better for battle, if you're going to call it that, than some of the other bureaus and agencies. Agreed. Interesting. Support for today's episode of Keys to Real Estate is provided by Rhino. Much like Monopoly, every move counts, and handling escrow accounts without the right tools is like getting to Boardwalk without a strategy. The stakes are high, and the risks are real. So bank on absolute financial protection with the Rhino software bundle. Rhino integrates with escrow accounting software and online banking systems to provide the industry's gold standard in escrow and financial security software solutions. Rhino offers continuous end-to-end accounting auditing, daily reconciliation, transaction monitoring, anti-fraud algorithms, and built-in automated reporting. Schedule a test drive today. Okay, data privacy. And I think part of this is maybe election outcome, election dependent, and part not. We keep at the federal level, we know that states are doing what states are trying to and able to do, which isn't very effective for most. But we see real starts either from, the FTC or sometimes in the Senate, sometimes in the House of some people who, and strange bedfellows on this one, that come together and understand the pluses and the requirements of it. But we don't ever seem to really get anything moved. Now we're now hearing that Vice President candidate Vance has some deep relationships with technology people, and so I don't know if how that's going to play into all this. But I'll just start with the big question of: do you think we're going to see federal data privacy regulation in our, I'll say, professional lifetime?
In our professional life? Well, say yours is much longer than mine, by the way, Mary. But that being said, and yes, I know, the comments about Vice President candidate Vance, who lives about 15 minutes from me, by the way, and I've seen his wife a couple of times, but who seems to be a very nice woman. But the thing is about the vice presidency, in the words of a former vice president from the 20th century, it's not worth a boot full of warm, and he didn't use this term, but I'll say water. And if you're the vice president, it's a lot like the old show Veep. You're waiting for the president to call. We've seen, outside of people like Dick Cheney, and to some extent, I think Joe Biden and the Obama administration, but we haven't seen a lot of activist vice presidents. So I don't know if, unless in a Trump administration, the president, empowers him to move forward on something, I don't know that that's going to be where it comes from. I think you're right, though. I mean, it's both sides of the aisle. Consumers are tired of being bombarded and having their privacy interrupted. Of course, as we know, and you and I have heard speakers who are talking about social marketing, and as the term has come up, surveillance capitalism. Yep. That the vast majority of consumers, when it comes to privacy, they give their privacy away. they click that button, and it's like, oh yeah, I accept all the cookies. And it's like, well, you're not Santa. Don't take all the cookies. Pick and choose what cookies you're going to want. And as far as federal legislation, the concern I've got, and maybe it's not so much of a concern as just having seen it, when we get into federal legislation on what are and under the umbrella of technology issues, federal legislation tends to be well after the fact. And by the time it's implemented, the marketplace has already moved on. And so, will we see federal legislation? Maybe. But as we see more states implement their own requirements, and obviously California is the high barrier because the California CPA and everything that's gone on in California. The initial law was very much like the EU's requirements, and then the voters of California made it tougher. They made it even stronger. So, California is going to be that high bar. I think that in the real estate industry and certainly in mortgage lending, in my conversations with compliance attorneys, both in-house and firm-based compliance counsel, is that, if you're a national mortgage company, you're not going to pick and choose what privacy requirements you're going to demand of your settlement providers. You're just simply going to implement the California rules because, first of all, it's the highest standard. And you never know. I was at New Mexico Land Title speaking about this this spring. And the question is like, well, why do we care in New Mexico about the California privacy rules? Well, you may care because the person who's coming in to buy that house in Santa Fe may be a California resident. And the view in the state of California is wheresoever they may be, if they're a California resident, they're covered by this. And privacy in California, as you well know, just giving out someone's address is a violation of privacy requirements. I mean, things that are pretty readily discernible through either through public records or simply by Googling them, you can find out about. You can't post that information. So I think that settlement agents, title and settlement agents, are going to have more and more demands on them. And as I tell my the title agents that I talk to and the settlement agents I talk to, echoing our dear now retired friend Penny Reed from Wells Fargo, read your closing instructions. Read your master instructions. What is it the lender requires of you? Because you may think those people are your customers. The lender definitely thinks those people are their customers, and they sent them to you. And you're going to have to meet those requirements. So I think we're going to see a continued rollout from the states because that's sort of an immediate knee-jerk political way to get things done. It'll move forward. Federal legislation, we may see federal legislation, but the federal legislation that may come into effect may be just a codification of what is sort of the reasonable standard of those states. But I'm sure there'll be a carve out that if a state wants to have a stronger statute like California's, they can do it. So I don't think we'll see a standardization. Might we see some national privacy law? Again, that's the makeup of Congress. Now, I dare say, with all due respect to members of Congress, it's a fairly dysfunctional place, especially the House. Whoever wins the House, and the Democrats could win the House, regardless of what happens in the presidential end of the election, I don't think anyone's going to have some 30 or 40 person majority. It's going to be near, so they're going to have to reach across the aisle. So I think it's going to be tough to get something through Congress, particularly the House. And I dare say, I think there's an awful lot of members of the House, and this is true of both parties, so I'm not picking on anybody, who have absolutely no idea what this issue is. And so, you have to rely on people who are skilled in that.
They think it's
in the
about
Senate, we
malware
probably
and
have
phishing.
more, but the House, not so much.
Yeah, they think it's about data security, not data privacy. And to your point, I agree with you. And so much of the work we do is on the national scale, that the state law that has the most consumer protection, I think, will be practically, fundamentally, what's adopted in operationally. Because to your point, a national lender isn't going to have one privacy posture for California and another one for New Mexico and another one for Wisconsin. it's almost irrelevant from at least the aspect of how we do our work. As a consumer, I think it's probably a little bit different. It's easier to go with, I think, a state to work within a state specific standard when you are talking about the group of services you provide. When you flip it around and look at the other way and talk about the group of services you consume, it starts to get a little more highly variable, I think.
I would agree. I would agree. It's a very difficult thing to deal with, and in many ways, the horse left the barn a long time ago.
Mhm.
And so, how do you? I hate to mix metaphors too much, but how do you put that toothpaste back in the tube? Where do we go? Where do we start on this? It's much like all the discussions about, well, we need to regulate cryptocurrency. Well, really? So, yeah, I'd say that has about as easy a chance as a federal privacy standard, because again, what is that privacy standard? I think the Democrats will probably push for something that's going to be much more restrictive than Republicans may.
Right.
Though we may have Republicans who are also going to have restrictive privacy laws because of their particular view of it and their constituencies' view of it. So it's going to be across the board. It's going to be hard to get through. And I think it's going to be very difficult in the next term, again, regardless, unless there is some dramatic change from what we see sitting here in the middle of the summer, such that one party really sweeps into power and takes both houses of Congress and the White House with a definitive majority so they can push legislation through as versus House Speaker Johnson's, one vote lead here, where, God forbid somebody becomes ill or gets hit in a car accident, he may no longer be the Speaker of the House. So I think it's going to be very difficult to get something through, though you're right, both sides of the aisle are very much concerned about this because of their constituency. But it's a lot easier to get it through state legislatures and state governors. And that's something that state legislators can point to very quickly and say, look what I've done for you and what we've accomplished. There's not quite so much grandeur to be gained by getting a federal law through for members of Congress.
Yeah, and to your other point, I'm not. And listen, I think data ownership, data privacy is a big. I'm a toddler that pounds my rattle on the high chair very often on that one, and I'm starting to wonder, not to be defeatist, but I'm starting to wonder if it's maybe not too late. Like you said, to try to get that toothpaste back in the barn. Well, to what end? I mean, we've got the current battles over what the AIs were trained on have to do not only with name, image, and likeness and content and copyright and all that. That is basically, hey, we just figured out about this, and I'm using this term loosely, this big heist that happened, and now we want you to pay us some points back on what was boosted. So that's interesting, but to the point of individual contracts about data and privacy and representations, I'm not sure how much that really matters now that most of the data all sits in one place. Ultimately, it's all going to one place. And you have things like, even if we get a data privacy law, like you have things now, there is a very popular online counseling situation that I'd kill for their marketing budget. We just found out recently that they're not good on data. All your therapy sessions are, that's beyond consumer preferences now. And it's out there. So all that to say, if we got a federal bill tomorrow, what happens with that stuff that's already gone and is still currently being collected? Like, you just disclose now that it's happening and everybody goes on down the road. I don't see how getting any toothpaste back in the barn is either A, possible, or B, at this point, how beneficial it would be for those whose data has flew the coop already.
I would agree. I mean, those data pools are out there. They're out there right now. And, how do you regulate those things that are already out there? And any bill that we get out of Congress, I think, will be highly reactive.
Yep.
And it will probably take some. Of course, we've had huge data breaches, government data breaches,
Yes.
but without such a public outcry that Congress immediately acted. Um, and there's discussion. I mean, if you do this, does everybody get a new social security number?
Right.
That's been something that's been discussed for some time. It's like, well, maybe we need to change that whole thing so we don't have these 9-digit numbers floating around anymore, and maybe we need to kill those off because, gee, don't the Russians have most of our social security numbers anyway, or whoever it is that's doing this? So yeah, it's very difficult, and again, we're used to this. How will consumers be happy if a bill gets passed such that it takes you 5 minutes to get to Amazon, so you can shop for something because you have to go through both privacy and security requirements to be able to accomplish this. So it's a very dicey question, and again, I think it's easier for the states, and in part because each state, dare I say, there's cultural differences. How North Dakota looks at this, how New York looks at this, how Texas looks at this, California, Florida. I mean, whatever state it is, they're going to have different things that are be reactive to their own constituency and their own populace, and as to their own needs. So if you're dealing with New York City or Chicago or Los Angeles or any of the Texas metro based entities, what do you do if a large corporation that has a huge data pool that is the source of a tremendous amount of commerce, and it's based in your state? Are you going to pass a law that's going to be highly restrictive to that company? So it becomes a very, very much a political hot potato. And again, Congress has to have knowledgeable people to draft legislation that's going to make sense and isn't going to be something that by the time it gets through Congress is already yesterday's news and isn't going to accomplish anything because, again, the toothpaste has left the barn.
The toothpaste has left the barn, buddy. Well, and I guess my advice to agents at this point is simply like, you may not be in control of everywhere the data is going. You may not even know where it ultimately resides and what the agreement is with whoever has that ultimate residency of data you believe to be yours or once was or something. I guess I just caution them this: don't inadvertently become an unpaid data broker. Data brokers are real jobs. They aggregate a lot of valuable information and sell it or otherwise bequeath it, give it to the open market. Just don't accidentally do that.
Right.
And I'm not talking security. I'm talking about ownership. So
I hear you.
Yeah, the rest we just have to watch and see. Okay. I really need to pick your brain on the attorney opinion letter title waiver issue that waxes and wanes, and we don't know whether to pick up our pitchforks or sit back because everything's fine. Where are we, and where do we think it's going?
Well, it's a conundrum. Attorney opinion letters, started to hit the press when Fannie agreed that they would accept them. That was spring of 22. Freddie has been accepting attorney opinion letters since the mid 1990s. And when Freddie, and in fact, I met with people from Freddie Mac in the mid 1990s when here in Southwest Ohio, which, as you're my friend Gary Funk from Freddie has said, is the epicenter of attorney opinion letters and has been for a long time. Pardon me. And when I started in the industry, way back in the Carter years, and say, for those of us for people who are listening who are younger, you may want to Google Jimmy Carter because, yes, he was a president of the United States. But when I started, conventional residential real estate loans were generally done through savings and loans, now known as thrifts or savings banks. Yep. And they used attorney opinion letters. When I opened my first title agency, our business was FHA, VA, and commercial. There really wasn't any conventional business. And entities like Citibank and national lenders that began to become involved in the industry on a national basis. They're the ones who started to move into title insurance. They didn't want to have to chase lawyers around. But here in Cincinnati, we had 134 savings and loans in the tri-state area, and they made the conventional loans. With attorney opinion letters at the time, it was a different world to a certain extent. But if there was a title problem, let's say there was an unreleased but paid off mortgage, you didn't close until that release was filed.
Right.
And so opinion letters, they are assurance. They are not insurance. Mm-hmm. And they are based off of visual examination. And the American College of Real Estate Lawyers and the ABA put forward an opinion 22 years ago, I guess now, an ethics opinion about attorney opinion letters of title, about what they can be and what they can't be. Pardon me. That letter has been adopted in many states. South Carolina is one that comes to mind. Just simply accepted. If you read through that opinion, many of the things that are required pursuant to the Fannie and Freddie selling guides would be unethical to provide. It's very clear. The points are there as to what you can do and what is an opinion letter. So, and I think right now, that's where the battle is about attorney opinion letters. What are they? How far can they go? We have seen companies come forward that have offered what they refer to as a blanket liability policy or E&O policy that, quite frankly, has never existed in typical law practice up until the creation of these entities. Very dramatically different. In a conversation I had with one of the large states, mutual indemnity companies, because we have so many attorney E&O providers who are state specific and quite often provide as much as 60 and 70% of all the E&O policies, particularly for solo practitioners and small law firms. And by and large, those companies provide little or no or quite expensive coverage for opinions, attorney opinions. It is an area that they feel is fraught with the potential of liability. And so I know that, in Kentucky, which is one of the states in which I'm admitted, yes, you can get, as a generally practicing attorney, you can get coverage, but it doubles your premium. And there's a limitation as to how many opinions you can write per year. And after that, you're on your own. So, what are opinion letters? And certainly ALTA has been very engaged with state regulators so that, are these wrapper E&O policies, is this not in fact title insurance? ALTA's position is, yes, it is. We've not seen a regulator really come forward with what certainly ALTA would like to see and to provide some clarity. But frankly, insurance regulators right now, I dare say, I think that the property and casualty crisis and issues in health insurance are sucking off attention from what we have in regard to this. But the attorney opinion letters that are out there now that meet the Fannie and Freddie requirements are very, very different from the opinion letters that I knew of when I started practicing and in fact have written. But the attorney opinion letters that I wrote at that point in time were always in the furtherance of the issuance of a title insurance policy. So it was simply an underwriting requirement. So the AOLs are out there. I think that, mortgage lenders have to make their decisions about what is it that they are prepared to do in regard to their own risk exposure. And, the MBA, for anyone who's a member of the MBA, the Mortgage Bankers Association retained the Blank Rome firm to put together a white paper about attorney opinion letters. What are they? What aren't they? What can they do? What can't they do? And it's a very exhaustive letter. I think it's very well written. And it's an advisory for MBA members. I think any MBA member who has not read that needs to rate it as to, what is it, what can it do for you? But again, as we talked about earlier, we are right now at historic low delinquency and default. And we have always seen that when title problems arise to the level of claims or litigation, it's in those times where houses start to go into the tank and loans start to go into the tank. And we will see that. And, right now it's all high cotton. So right now it all sounds great. It's like, hey, we can do this, we can save a few bucks, be cheaper on the street. But what happens when, not if, but when there's a turn down? Are lenders prepared for what may happen next? And they should read the Fannie and Freddie selling guides very carefully, because both those selling guides provide that if there is a title issue, particularly in regard to real estate taxes, that you're going to get that loan back. And now it's your problem. And now you have to find John Smith or Mary Jones, who wrote the opinion, and see what liability can be obtained. And again, those proponents who are out there for AOLs say, well, we think we've got that licked. We think we've got, a wrapper insurance that can last life of loan. But again, if it lasts life of loan, sounds like title insurance to me. So, will we see a state regulator come forward to provide some clarity? I would certainly hope so. I wouldn't hold my breath at this juncture, because they have so many other issues to deal with, and so many state agencies that regulate our industry, really in regard to our industry, are relatively understaffed. Texas is one of the exceptions. But by and large, as you know, in Illinois, I think it's still 2.5 people regulate title insurance. It is
Right.
a ridiculously low number of people for a state that is one of the top 10 states in terms of premiums written.
Yep.
I think the AOL question is going to go on for a while, but I think that, where these decisions will be made about what sort of title evidence, or, as we mentioned, title waiver, and I'll talk about that in a second, what is the lender prepared to do? Because they're the ones who are on the hook, and they need to be thoughtful about, it's not just what the salespeople are telling you. Gee, we can be $200 cheaper on the street. That sounds great in 2024, but in 2027, that may have sounded like being penny wise and pound foolish, because now, and the exposure that was discussed, I believe, in regard to Fannie in particular, was a potential annual exposure of $167 million. Where's that money going to come from, especially for loans that are in the tank? So it is, it's an issue, and sometimes it is labeled as being advantageous to the consumer in terms of affordability. I think that's a red herring. In many states, in fact, because the discounts we offer, it's actually cheaper to get title insurance and get some coverage. The attorney opinion letter doesn't cover all the same things, pardon me, and may not cover the consumer at all. So they're relying on the warranty covenants of the deed for a seller who has since moved to Manila and is unable to be found. So, this is, it's a hot topic. Again, the branding of it as well. This is, it makes it cheaper to close. That's something that needs to be examined. And again, value as to the consumer. What is the consumer getting in regard to this and not getting? And do they understand what they are getting and not getting? And that is a great concern, I think, in our industry and at Alta, is that 2 or 3 years from now, people will be turning to us and saying, hey, what the hell was this all about? And we're going to be like, well, we told you. And not a lot we can do for you now, unless you're going to go buy a policy that may have exceptions to it, because, well, now we know there are problems. So, the AOL issue, I think it's a lot of it is piggybacking onto what has been an historic legal product but it's a very different animal as how it's being described now. Pardon me. That being said, the title waivers, the which of course came up during the State of the Union address. Fannie had examined that. They took a pass after examining it. Now it's been dumped back on their desk. It's been dumped on Freddie's desk. We'll see how all this goes. We have an RFP outstanding from both Fannie and Freddie. Excuse me, allergies. You know how it is in the Midwest.
I do.
And we'll see what that RFP says, because what sort of process will be acceptable to the GSEs to waive the title insurance requirement, and will it involve actual examination of public real estate records, or, as has been suggested, will be based on algorithms that may have no relationship to real estate records that come into play. And it has been raised that if that algorithm comes into play, and if they are tied to FICO scores, does that not raise a FICRA problem? So these are all a lot of questions that come into play about title waiver. I think that, again, if we are in a Biden 2.0 administration, we will see a continuation about examining this, but we'll see how far it goes, and we'll see how far Fannie and Freddie choose to go, and how far lenders choose to go. I mean, we have seen, one national lender, United Wholesale Mortgage, they're out there with their Track and Track Plus programs that they're offering to do a very different sort of process, but it's a wrapper sort of pricing that they're doing. But I think it's something for all, for the lenders to look at and say, well, if we do this, we take the waiver, what happens when that loan goes in the tank? Is this our problem, or is Fannie going to indemnify us? And has been a comment that was made by someone at Fannie. Well, if we have that problem, we will simply fix those issues as they come forward. It's like, what department at Fannie Mae is going to do that? The title industry, we are highly knowledgeable about what is sometimes regarded as an arcane segment of the real estate industry. And where's the money going to come from? Where are the people going to come from? How are they going to do it? So I think the title waiver, and I think if we get into a Trump 2.0 administration, I think we may see the heat turn down on the GSEs about looking at waiver programs. I don't know that to be the case. I think it's interesting that I was talking to a title agent from Delaware a couple of months ago, and he said, I have handled 5 transactions for Joe Biden. He has owner's policies on every one of his properties. And dare I say, Donald Trump's a developer. Developers generally aren't real crazy about costs, and they're not real. And Donald Trump is shown to be not real crazy about banks generally. So we'll see how this all plays out. But I think the title waiver programs, these are troublesome from the standpoint that I think the GSEs are struggling about how to do them prudently, so that maybe sometime, not in my lifetime because it won't happen, but maybe in your lifetime, Mary, they may come out of receivership yet. That it'll be stunning. And so, when you're in your 90s and you're at the old title agent's home, you can reflect on, well, I remember when Chuck said. But I think that this is going to be troublesome for the GSEs. And I'll just add here, by way of shameless plug, that at the Mortgage Bankers Association Compliance and Risk Assessment Conference in September in Washington, I will be on a panel with Trip Riley, Brian Levy, and we will be talking about these. And of course, Trip represents both lenders and people in the title insurance industry. Brian heavily in the lending industry. Brian and I had a panel actually last year in 23 at NS3 in St. Louis on the same topic. I think where this ball ends up is in the lenders' laps. And the lenders are going to have to make their decisions what they're going to do their due diligence and to prudently move forward. So if they originate a loan and they sell the loan, they never have to hear about it again.
I agree with you. And in certain ways, this feels very similar to the Ron acceptance situation, which is, okay, we have a new way of doing things. We think it's going to solve these problems. And then you look at the potential adopters and they go, we're not that really worried about those problems. So you've got a solution that doesn't really help us. But then, oh, wait, cost is a problem and it can help reduce costs. So, okay, that's good. We're all interested in talking about costs, but it's feeling very similar to, we think we've got the Ron legislation pretty well done. We think these notes are defensible in court, which is the only thing, to your point, that actually matters. It's kind of like this. And once again, no matter what the GSEs potentially lay out as acceptable, I think we're going to have lenders continue to say, we're not sure how legal this is or isn't. We'll wait till somebody figures it out, but you're not going to find it out with my potential liability when those injured loans come back to me. It feels like it's shaping up very similarly, but it may not be at all. I don't know.
I think you're right. I think, and I hope no one takes offense by this comment, but it was made to me many years ago by a very senior person at a very, very large mortgage company that happens to be based in Detroit. But his comment was about Ron, he said, it is very much like a teenage boy and sex. They all wish that they have done it, but they're afraid to do it. Now, and again, I hope no one finds it to be too off color, and if they do, I guess they do. But and you'll have my contacts. I wait for your cards and letters. But
there you go.
And that's a struggle. And I remember again, Bill Eastman, when he was president of Rocket, and he's the man who really came up with the Rocket concept. He said, with mortgage lending, he said the problem that mortgage lenders have is because, of course, we have this roller coaster market historically. So either things are great, like 2021, or dire, like the end of 2022. And he said, as we're in this roller coaster market, he said, as you're coming down off that high, you have money, you've seen the problems that you had when you were deluged with business. That is a time to make technological and business process changes. Or the market's coming back up, you see they're going to have these issues. So you're at the other side of that curve. And those are the two times that mortgage lenders really have the opportunity, because there's enough money and there's enough time to make those changes. And if you're not at one of those points, nothing's going to happen. And so, it's a problem. And say, certainly, the mortgage industry now, I think that there are some significant differences. And you hear it when you're at an MBA meeting, is that, they are driving harder and harder towards technological changes because the cost to originate a mortgage loan is just so skyrocketed. The average loss on originating a mortgage loan is in the hundreds of dollars nationally. But as my friend Tony at MBA pointed out at a recent meeting, he said, the average loss, I think at that point was about $500 to $600 was what a lender had lost on pure origination, not from sale of the loan, but from pure origination. But he said there are some companies, highly technologically oriented companies, I mean, named a few, and people like Rocket Guaranteed Rate, people like Loan Depot, he said they're actually making money. They're clearing a few $100s. So that means that, that national average, if they're making a few $100s and given their volumes, that means that smaller mortgage lenders are losing a couple $1,000s to originate a loan. They've got to do something. And their only way to do it is by driving down the internal labor costs and by making it a more mechanized process. And that's where things like AI come into play, where we come, automated valuation. We just saw the CFPB come out about automated valuation, and credit reporting. You know, the MBA has been making comments for some time. Bob Brooksmith has made many comments about how the cost of credit reports have tripled. And so, you know, underlying costs, they've got to knock those underlying costs down somehow. So we are in one of those points. But yeah, I think to your point, you know, it's something where when we have these changes come into effect, or we have these opportunities, the lenders have to decide which way they're going to go.
Well, thanks, Chuck. For the first half of this conversation, we went all the way around a couple of barns, and, and I loved every minute of it. So, audience, Chuck will be back next week as we finish part 2 of our conversation. And now that we've talked about how the lay of the land looks, we'll zoom in next Thursday to talk about what to do about it. So until next time, keep doing what you do so well and keep your eyes and ears trained here to stay current on all the interesting changes going on so you can confidently hold your keys to real estate, because at October Research, we know that knowledge is the competitive advantage.